Hey guys, if you haven't heard, the DSCR loan is literally one of the best programs when it comes to building your portfolio and one of the best mortgage programs as you're going out there and scaling and buying your investment properties. So if you've been trying to buy a residential investment property and keep running into roadblocks, tax returns, debt to income ratios, or limits on how many properties you can own, this video is absolutely for you. Today, we're talking about the DSCR loans in 2026, what they are, how they work, and when they actually make sense for buying residential investment property. There's no hype, no shortcuts, just clarity. Okay, first, let's define what a DSCR loan actually is. DSCR stands for Debt Service Coverage Ratio. So in simple terms, this loan qualifies the property, not you. Instead of asking how much income do you make, the lender asks, does this property's rent cover its own payment? That's the shift. So if the rent can reasonably cover the mortgage, taxes, insurance, and HOA, the loan may work. Your personal income becomes far less important. So why are DSCR loans so relevant in 2026? Because many investors today are self-employed, or they own multiple properties, or they might write off income aggressively on their tax returns, and on paper it doesn't look that great. In reality, they're very strong investors, and DSCR loans were built exactly for that gap. In 2026, they continue to play a key role because traditional underwriting remains tight, investors want scalability, and residential rentals are still in demand. But that doesn't mean DSCR is for everyone. So let's talk about what properties qualify. DSCR loans are typically used for the residential investment properties that are out there, and that includes single-family homes, 2 to 4 unit properties, condos, and townhomes, and even sometimes short-term rentals. These are not primary residences. They are not second homes. The intent is income. Lenders look at either current lease agreements or market rents using appraisal. If the projected rent supports the payment, the deal moves forward. If it doesn't, it stops right there. So let's break down the numbers because this matters. Most DSCR lenders look for a ratio around 1.0 or higher. That simply means the rent roughly equals the payment. Some programs allow slightly below that. Others reward stronger ratios with better pricing. And this is why the purchase price and rents matter more than emotion. You're not buying a dream, you're buying math. Strong DSCR deals are boring, and boring is good. Let's talk about down payments and credit in 2026. DSCR loans usually require more skin in the game, typically around 20%. Down payments are often higher than owner-occupied homes, and credit standards are reasonable, but they're not crazy loose. And this isn't intentional. These loans are built for investors who understand risk and plan for reserves. Liquidity matters here, and the goal is not to stretch beyond your comfort levels. It's to survive downturns, it's still cash flow. And one of the biggest benefits of the DSCR loans is scalability. Traditional loans often cap how many properties you can own. DSCR loans focus on deal equity. If the property works and you have reserves, you can continue to grow. And that's why experienced investors like these programs. They separate personal finances from a portfolio strategy. So let's address the common misunderstandings. DSCR loans are not no documentation. That's a different documentation. They are not risk-free. Bad deals still fail, and they're not always the cheapest options. Rates can be higher than conventional loans, but the flexibility is the trade-off. You're paying for speed, simplicity, and scale. And for the right investor, that trade-off makes total sense. So who should consider a DSCR loan in 2026? This works well for investors who are self-employed, have multiple properties, want to scale intentionally, understand cash flow, and plan to hold these long term. It's not ideal for someone chasing appreciation only, or ignoring reserves, or even hoping that rent will figure itself out. The DSCR rewards discipline. And final thought, DSCR loans are a tool. They're not a strategy. They work best when paired with patience, math, and long-term thinking. In 2026, residential investment property still creates opportunity, but only for investors who respect leverage. And finally, make sure you're working with a lender and a real estate agent that own both investment properties. You need to work with those who have been there and done that, putting you on the right track for success.